Hello everyone, this is CSCS Chintan Devalia teaching financial management at intermediate level and strategic financial management at CA final level since last 20 years. Students, I do welcome you all to the wonderful world of financial management, and I do presume that the level of preparation you are targeting for your next exams is rocking. But I assure you, with the kind of recap we are going to take for the chapter, it will make your chapter reach a new heights. And without wasting more time, let us start with a chapter for the day, that is analysis of leverage, students. That is this. Now, what is leverage? I think everybody knows it. Leverage is nothing but risk. And this risk, students, this risk is generated from what? The presence of commitment taken by the company in the form of fixed cost. Now the question is, why only fixed cost? Because variable cost varies with the production. What is fixed cost? Which remains constant irrespective of the level of production. So student, leverage is said to generate from the presence of fixed cost. Yes, no? Because that actually indicates the level of risk. Now this fixed cost technically can be divided into operating fixed cost and financial fixed cost. Now, when I say operating fixed cost, these are the fixed costs which are related to the routine activities of the company like rent, salary, depreciation, etc. And financial fixed cost, student, there are only two. Those are interest and preference dividend. There cannot be etc. in financial fixed cost, because we have studied that financial fixed cost can be only two: interest and preference dividend. And the moment I combine them, what I can derive is total fixed cost. Considering the chapter on the further level, student, the risk generated from operating leverage is DOL, yes, no? Risk generated from financial fixed cost is DFL, and the moment I combine them, that is nothing but degree of combined leverage. Yes, no? So we can derive operating leverage from the presence of operating fixed cost. We can derive financial leverage from the presence of financial fixed cost, and the moment I consider both of them together, we derive combined leverage. Now, we have studied various formulas of this chapter. What is the name of the chapter? Name of the chapter is Analysis of Leverage, students. So, there are two different categories of formula. One is leverage and second is analysis. Yes, no? When I talk about operating leverage, student, operating leverage generates from the presence of fixed cost. And when I say presence of fixed cost, imagine up and down of fixed cost. Student, the formula is going to be contribution upon EBIT. Yes, no? Same way, financial fixed cost is interest and preference dividend. If I talk about up and down of interest and preference dividend, it is going to be EBIT upon EBT. But remember, very important, it is PD upon 1 minus T. Do you remember this? Majority student only remember EBIT upon EBT. But that is only when preference dividend is not applicable. What if preference is applicable? We add PD upon 1 minus T. Add matlab, we add in the formula as far as PD upon 1 minus T is concerned. But that addition is considered to be deduction from EBT. Yes, no? Now, if I combine them, the formula is going to be contribution upon, can I say EBT minus PD upon 1 minus T. Student, this is the complete formula of operating leverage, financial leverage and combined leverage. What about analysis? The analysis is again applicable. What is operating leverage? Impact of change in sales on operating profit. And we understand impact of change in sales, that is percentage change in EBIT due to percentage change in sales, that is analysis formula. Financial leverage, impact on EPS due to change in operating profits. And if I combine them, the formula I can derive is percentage change in EPS upon percentage change in sales. Yes, no? So I can easily say impact of sales on EBIT is operating leverage. Impact of EBIT change on EPS is financial. And if I talk about impact of change in sales on change in EPS is combined leverage. So student, this is a overall concept of formulas of combined leverage along with operating and financial. And one more thing, the two things which you need to understand more is, student, you should always remember a statement of EPS computation, yes, no? It starts with sales minus variable cost, minus, that is gives you contribution, minus fixed cost gives you EBIT, minus interest gives you EBT, minus tax gives you PAT, minus preference dividend gives you profit for equity shareholder, divide by number of equity share gives you earning per share. So this is one, you need to revise it. And number two, revise the formula of profit volume ratio. Remember, it's a contribution upon sales into 100. Needless to mention, we have studied this in costing, yes, no? Yes. Done? So these are the major concepts which you remember by revising the formulas of leverage chapter. Now students, let us have a quick view of the whole chapter. Coming back to the question 1 of our classwork, students, this is a very basic example whereby you are supposed to just calculate operating, financial and combined leverage. Prepare a statement of EPS. Normally we say income statement of both the company. Apply the concept and calculate operating, financial combined. Done. Second question, student, equally basic example. One company only. Prepare income statement. Calculate DOL, DFL, DCL. Very simple normal example. Third, student, little unique. Why? Because the question gives you break-even point concept. Okay. And they ask you to calculate DOL at a volume of 25 and 30. Student, if you remember, in this example, fixed cost is missing. And this fixed cost can be calculated by applying the concept of break-even point. So, we have sales, we have variable cost, we were out of coverage for the fixed cost is concerned. So, by applying a concept of break-even point, that we can say fixed cost upon contribution per unit, break-even point, you can calculate fixed cost. Fair enough? And thereafter, next question, student, this is the most frequently asked question at your level. One company balance sheet is given, asset slabs are given, certain information of fixed cost, variable cost, total asset turnover ratio. Student, what is the formula of total asset turnover ratio? Sales upon total asset. 2.5 is given. We have total asset, we can calculate sales. And after applying sales, just apply income statement. You are done with EPS, operating leverage, financial leverage and combined leverage. Clear everyone? At times, here point number 5, they have a practice of asking you comment also. Student, this is one company. So when you comment on that one company, student, it is very important is how you comment. When there are multiple companies, you can say one is high risk, one is low risk, one is moderate risk. But if there are more than one company, that is possible. What if there is one company? Can you say this is high risk, low risk or moderate risk? Not possible. So the only way is you have to get hold of every leverage individually. Like if I take an example of operating leverage, you have to just interpret. Okay, due to change in sales, EBIT will change by this much. Take example of combined leverage is 5. You can just put a comment that due to change in sales by 1%, EPS will change by 5%. That's it. Very simple language. Clear everyone? That is operating, financial and combined leverage comment. Question 5, student. Again, very classy. We have operating and combined leverage. You can easily calculate financial leverage. By preparing an income statement with the help of given information, you can calculate PV ratio and EPS. And thereafter, you have to comment on the asset turnover ratio. If the asset turnover ratio of the company is less than 1.5, which is of industry, then it has a low ratio. And if it is more than 1.5, it is a high ratio. And last, what will be EBT at which, what will be sales at which EBT will be 0? Now, there are two ways of calculating this. If you are technically strong, student, you should apply the concept of combined leverage. If not technically strong, the best way is to do a mathematical approach. Student, prepare a format from sales to EBT. Take EBT 0, go reverse, calculate sales. Full marks to you. Clear everyone? Next, question 6. Student, 100% last minute revision. Very basics, everything is given. First part, they will ask you ROI. What is ROI? Return on investment, which is return on capital employed. Fair enough. EBIT upon capital employed in 100. Favorable financial leverage. Student, remember, if the return, that is ROC, you have calculated is more than your interest rate in this example, then it is a favorable financial leverage. Otherwise, it has an unfavorable financial leverage. Fair enough. Thereafter, comment on capital and turnover ratio, that we have done. Calculated operating financial combined leverage, that we have done. And thereafter, 0.567, student, there are two ways of calculating. Again, I would highlight, if you are technically strong, apply the formulas of leverage, analytical formulas, percentage change concept formulas. If not technically strong, student, just blindly prepare a format of income statement as per the requirement of the point, and thereafter just go back, reverse and calculate the balancing figures. I am sure any of them you followed, you are going to get full marks. So don't get panic. So whether we should apply analytical formula or a mathematical concept, both of them are equally acceptable. Question number 7. Student, this is the first question where you are going to tackle preference dividend issue. Yes, no? Yes. The first 6 questions, there is no preference dividend. And whenever preference dividend is there, student, combined leverage and financial leverage will have a concept of PD upon 1 minus T. This is DFL, degree of financial leverage. To make it a point, when you are going to calculate point number 3, degree of financial leverage at current level, the formula which you are going to use is this. Don't be overconfident about preference dividend point, students. Whenever preference dividend is there, do take PD upon 1 minus T as a part of the formula. If not there, fine. It's a EBIT upon EBT. Done. And here you have to calculate EPS and EPS with 30% change in EBIT, both increase and decrease. Again, you can apply financial leverage concept or a mathematical tabular concept. Thereafter, what additional data do you need to calculate operating and combined? Student, what is the data which is required is the operating fixed cost. If the operating fixed cost is available, you can calculate contribution, and then operating leverage and combined leverage are easy for you. Fair enough? This is theoretical part. Student, again, very, very important question. This has to be a last minute preparation for you. Student, this question is a combination of leverage and ratios both. They've given you equity, preference, debenture. Again, preference is there. PAT is given. Operating expense including depreciation. Student, depreciation is operating fixed cost, is 1.5 times of EBIT. So you will be able to derive EBIT into 1.5 operating fixed cost. Sorry, operating cost will be ready, and out of that operating cost, deduct depreciation, you will get what? A variable cost. That is the way you need to calculate variable cost. Student, this too will be applicable only for calculating the ratios. Nothing to do with the leverage. And thereafter, what they've asked you is operating and financial leverage, easy for you. Cover for preference in equity, it's a preference dividend coverage and equity dividend coverage. Earning yield and price earning ratio, pure ratios, and fund flows, what you have learned in ratios is one and the same. Fair enough? Point number 9. Students, point 9 is unique as far as first part is concerned. Second part is a cakewalk. Why cakewalk? Because they've asked you to calculate operating leverage when combined leverage is 3. So student, combined leverage is given, operating leverage is missing. The first target for you is to calculate DFL, and applying that DFL, thereafter you can calculate DOL. Yes, no? Yes. But the big point is, that is segment. Student, this. In this first part, you have to identify return on equity first. And when I say return on equity here, it is return on equity shareholder fund. And thereafter, if you remember, student, the return on equity shareholder fund in this example is 13.6. And thereafter, you have to indicate the segment by preparing an income statement starting with EBIT to EPS, not EPS but profit for equity, and thereafter to comment that what is the impact due to presence of debenture on equity shareholder, preference shareholder on equity shareholder, and equity shareholder on equity shareholder. Matlab, you have to understand that what is the impact of presence of debenture on equity holders earning, preference shareholder on equity shareholder earning, and equity shareholder on equity shareholder earning, and that will give you a combination of 13.6% returns. Clear everyone? The impact can be positive, impact can be negative. Clear everyone? That was just question number 9. Homework section, student, this is very basic. This is the classic, student, very important. You need to take this as a last minute revision. Student, this is one question where company is dealing with various combination. Check out, they have two kinds of fixed cost, they have two financial plan. So if I talk about situation 1, there are plan AB, and situation 2, plan AB. That means in and all, there are 4 combinations available for the company. If I prepare a table, it will be from sales to EBT. I repeat EBT because the tax information and further information is not available. 4 DUL, 4 DFL and 4 DCL. Student, one company has 1 DUL, 1 DFL, 1 DCL. But here one company has 4 DUL, 4 DFL and 4 DCL. Why? Because this is a stage where company is evaluating different combination of risk. And here out of 4, in long run we have to suggest any one which is according to the risk taking capacity. So this is not something a routine example where company has undertaken risk, you are calculating 1 DUL, DFL, DCL, finished. No, here we are evaluating different combination of risk applicable at different all the 4 levels. Fair enough? This is again routine, DUL, DFL, DCL. Students, this question number 2, question 3. I'm sorry, 2 part. This is again last minute, student. We have to prepare an income statement with the help of missing frequency where financial and operating leverage are given. And you can apply the breakup formula. What is financial leverage breakup formula? Remember, it's EBIT upon EBIT minus I, presuming preference dividend is not there. And DUL is contribution upon contribution minus fixed cost. Do you remember this? A very important breakup formulas, and these formulas are useful only when some missing frequencies are to be calculated. Fair enough? Question 3, student, again calculate operating financial combined and interpret. And as far as interpretation is concerned, this time you have 3 companies. Calculate operating financial combined and target combined leverage. A company with high combined leverage, high risk, low combined leverage, low risk, and moderate will be the moderate one. The third one will be the moderate. Fair enough? Question 4, student, again very simple. You have to calculate EPS at 60 and 50, and thereafter depending upon percentage increase decrease, you can calculate that. DUL at 60-50, financial at 60-50, mind well, combined leverage is not asked to you. So just prepare 2 columns, EPS, give a change in EPS, thereafter DUL and DFL, 10 marks, cash marks. Question 5 is routine, student, only operating and financial. And question 6 is again a basic missing frequency income statement. Obviously operating and financial leverage are given, you are in the position to justify income statement. Clear everyone? So student, what I have given you is a very quick recap of all the important points which are there in this chapter. Just go through these points. I am sure you are able to make a most of it. Fair enough? So I think student, this is more than enough as far as a quick recap is concerned. With this, I would love to take some add-on part for you. I am sure this add-on part will make the level of chapter reach a new heights. Let me check the first part. I have already kept it ready for you. Student, check out the first question. From the following information extracted from the books of account of IMAX Limited, calculate underlying percentage change in EPS if sales increase by 10%. Student, sales change हो रहा है, EPS ढूंढना है, sales change हो रहा है, EPS ढूंढना है. Think which leverage? Sales to EPS. Perfect. Combined leverage. And fixed cost is given 157,500. EBIT is given 31,50,000. EBT is given 14 lakh. Students, the big point is the sales given? No. Is the EPS given? No. Then the question arises, how we can calculate? Student, you can calculate with the help of combined leverage, because what is given, sales change is given 10% and EPS you have to calculate. So I can easily start with calculation. Dhyan dijiye. Please concentrate. When I say, is sales given? No. Is variable cost given? No. Is contribution given? No. Student, is fixed cost given? Yes. Check out, fixed cost is 1,57,500 students. EBIT is given, students. Check out EBIT, 31,50,000. And interest is not given, but we are very much ready with EBT. Yes, no? Yes. What is EBT given, student? Check out in the question. EBT is 14 lakh. That means I am very much comfortable calculating the remaining balancing figure. Your interest will be 17,50,000. And if I go backward, 31,50,000 plus 157,500, your contribution is 33,07,500. Yes, no? Now, honestly speaking, students, the table I have taken is only for your comfort level. In your exam, you can or you cannot prepare the table, provided you are comfortable that EBIT plus EBIT plus fixed cost will give you direct contribution. So I can calculate DCL now. What is DCL? Contribution upon EBT. What is contribution? 33,07,500. EBT is 14 lakh. So I can directly calculate DCL. Student, there is no hard and fast rule that you need to calculate operating and financial both in order to calculate combined leverage. No, you can directly apply the formula, that is 33,07,500 divided by 14 lakh. Student, my combined leverage is 2.3625. Yes, no? Now this is mathematics. Now I need to apply the analysis of 2.3625. Students, remember, what is the analytical formula? With help of DCL, we can say DCL is percentage change in EPS. Remember, divide by percentage change in sales. Do we have percentage change in EPS? No. Do we have percentage change in sales? Yes, plus 10. This is 2.3625. Student, apply the mathematics now. Can I calculate the answer? And your answer is going to be yes, 23.625%, and that too positive. Yes, no? Why positive, student? Because sales is increasing by 10%. And as sales is increasing by 10%, okay, you need to calculate percentage change in EPS, that is 23.625. Clear, everyone? Very simple 5-marker example. Standard. Again, preparing table is optional if you understand that fixed cost plus EBIT is going to be your contribution. Otherwise, no harm in preparing a table itself. Clear, everyone? That was the one small example. Clear? Check out number 2. Again, very simple. Consider the following information of Mega Limited. Production level 25,000, contribution 150 rupees, operating is 6, combined is 24. I am sure your mind has started working. You are able to calculate financial leverage, but no need. No need. Check out further. Tax rate 30%. What they've asked you? Calculate earning after tax. Student, they've asked you profit after tax or earning after tax. Question starts. From where should we start? Students, every time you are not supposed to prepare a full-fledged format. Just concentrate well now. Starting with number 2. Student, check out. Do we have calculation of DCL ready? Why DCL? Because DCL is given 24. Can I calculate DCL directly? Yes. Contribution upon EBT. Do we have a contribution ready? Yes, it is 150 rupees contribution into 2500 units. EBT is missing and DCL they have given. Check out DCL is how much? Check out DCL is how much? DCL is already given to you. DCL is 24. So if I work on this, this is 24. Therefore, I can easily calculate EBT now. That is 150 into 2500 divided by 24. This is 15625. This is EBT. What is the target? Is PAT. Now I can say that EBT is 15625 minus tax 30% given. So this is 30% is 4687.5. Can I calculate profit after tax, which is earning after tax? 10937.5. Very simple. Student, the moment we calculate DCL, applying the concept of DCL, we calculated EBT minus tax gives you PAT. 5 marks. Student, even you can do this example by calculating DUL, DFL, then DCL and then calculate the answer. But no need. When the concept is strong, you can get me the smart answers. Clear everyone? Okay, good to go ahead. Come to question number 3. Student, check out this. From the following information, prepare income statement. Check out income statement of A and B. Student, only income statement. And check out A and B. Something new. Student, very rarely student knows this. Margin of safety. Student, what is margin of safety? I will take it later on. Interest is given. Profit volume ratio is given. What is profit volume ratio? Contribution upon sales into 100. Further, financial leverage is given and tax rate is given. Student, I will be just concentrating on company A. Thereafter, company B, you can take it at your own level. Come to the example. Yes. Student, if I just prepare income statement, that is question number 3. It goes like this. This is only for company A. I can say sales minus variable cost gives you contribution minus fixed cost gives you EBIT minus obviously interest gives you earning before tax. Student, minus tax gives you profit after tax. And there is nothing like preference, dividend and so on. So I can just put a small end to this. Student, check what are the ready-made figures given in the example. The ready-made figure, company A, interest is only given. Yes, no? Interest is given, students. Let me check this. Interest is, I think 3000 if not wrong. And tax is 45%. Am I clear? Interest is 3000, tax is 45%. Yes, very much perfect. Now, can I proceed? Interest is ready-made figure, student. So applying working note 1, which will be the concept of DFL. Why DFL? Because interest is given. So I can take EBIT upon EBT or EBIT minus interest, and DFL is given, student, in the example. Check, DFL is 4. So applying that concept, EBIT upon EBIT minus 3000 is 4. Can I calculate EBIT now, students? Anji, can I calculate EBIT now, everyone? So obviously EBIT will be 4000. If I cross multiply and do the mathematics, so putting 4000 here, this will be 1000. 45% is 450. So 550 is PAT. Simple. The moment I get EBIT, I can proceed further and close up to PAT. Okay, now working note 2. Students, for working note 2, I need to take help of margin of safety. What is margin of safety given, student? That is 0.20. What is margin of safety, student? It's a reverse of operating leverage. What is operating leverage? Contribution upon EBIT. So this is EBIT upon contribution. This is 0.2. EBIT is what? 4000. contribution missing, this is 0.2. Student, this is a very important concept of margin of safety. Students, I can easily calculate now. My contribution will be 20,000. Am I right? Yes, no? Students, even there is a different way of calculating it. Huh? Can I call DOL as 1 upon margin of safety? Reverse, reciprocal. So DOL is going to be 1 upon 0.2. So if I talk about 1 upon 0.2, this is going to be 5. Yes, no? So you have calculated DOL 5 and now applying DOL. DOL is contribution upon EBIT. You can calculate 5. Contribution we don't have. We have EBIT 4,000. So even we can calculate contribution as 20,000. So student, margin of safety, if I just talk on a very simple formula base, margin of safety is reciprocal of DOL. So I can say margin of safety is either EBIT upon contribution or DOL is 1 upon margin of safety. Student, there is a third concept, which is a technical concept which I just pinpoint that. Margin of safety indicates excess of sale over break-even sales. That means any sale over your break-even sale is margin of safety. But rather than going into that technical part, I would say remember this two formula. Margin of safety is either EBIT upon contribution or DOL is 1 upon margin of safety. Clear everyone? Even you can say margin of safety is 1 upon DOL. It's one and the same. So with the help of this, I can easily say my contribution is 20,000. Students, I can take contribution 20,000. So balancing figure, your fixed cost is 16,000. And as the PV ratio is given, student, what is the PV ratio? 25%. So if I take that 25%, I can say our contribution will be 25%, provided sales is 100. So this is 75%. Can I? So this is going to be 25% is 20,000. So this is going to be 80,000 and this is 60,000. Clear everyone? This is pure simple income statement of company A. On this basis, you can, as a part of practice, prepare income statement of company B. Clear everyone? So what we have done, we have taken working note 1, whereby we have calculated EBIT. We have taken working note 2, whereby I have introduced a very good concept of margin of safety, which is either EBIT upon contribution or DOL is 1 upon MOS or MOS is 1 upon DOL. It's one and the same. Okay everyone? Good to go ahead? So do remember concept of margin of safety. Next, I can take question 4. Check out question 4, students. What is given? Very simple. Sales revenue of TM Excellence is 20 per unit and output is 20 lakh rupees. So you can easily calculate number of units. Contribution is 10 lakh. At present level of output, DOL of the company is 2.5. Student, at present level output, DOL of the company is 2.5. DOL is given. The company does not have preference share, no preference dividend. Number of equity share are 1 lakh. Applicable income tax rate is 50% and interest rate on debt capital is 16%. Preference dividend is not there, but interest is there. What is EPS? At sales revenue of 20 lakh. Students, you have to just calculate earning per share by preparing a table. And the amount of debt capital of the company, if 25% decline in sale will wipe out the EPS. That is something different. Let us calculate. I will take this as answer 4. Student, they have given you DOL. What is formula of DOL? Contribution upon EBIT, yes, no? Do we have contribution 10 lakh? We don't have a EBIT. But student, we have this as 2.5. So can I calculate EBIT as 4 lakh? I think very simple. Yes, no? With that, I can easily calculate now. Fixed cost. What will fixed cost? That is contribution, that is, you can say contribution minus EBIT. What is contribution, students? 10 lakh. EBIT is 4 lakh. So logically we can say fixed cost is 6 lakh. Am I clear? Absolutely. Now, concentrate well. If I apply the concept now, they've asked you the income statement whereby you can calculate EPS. Yes, no? But that does not mean every time you prepare a full-fledged income statement. Still, if you are willing to do that, you can. Think. Do we have sales? 20 lakh. Variable cost is missing, but contribution is 10 lakh. Yes, no? If contribution is 10 lakh, the variable cost is 10 lakh. Simple. Balancing. Student fixed cost, we have just calculated 6 lakh. As your EBIT is going to be 4 lakh. Am I clear, everyone? We are done with EBIT. EBIT is 4 lakh. Now the question arises, sir, where is the interest? 16% rate is given, but we don't have an interest amount because the debt capital is missing. Tax rate we have, PAT obviously missing. Student preference dividend, they have said it is dash. So I can easily calculate balancing figure as profit for equity shareholders. Yes, no? I can take divide by number of equity shares. That will give me earning per share. Student question arises from where I can get the interest. Check the last line of the question, very important. What will be EPS at sales around 20 lakh? And amount of debt capital of the company if 25% decline will wipe out EPS. Matlab, if the share decrease by 25%, EPS will become 0. That means EPS, whatever EPS is right now, it will become 0. That means there is a 100% fall. So 25% change in sales will bring 100% change in EPS. And student, with that concept, I can easily apply the concept of just big concept. Can I apply concept of DCL? That is percentage change in EPS upon percentage change in sales. Student, change in EPS is 100%. Due to change in sales is 25. When I say EPS is wipe off, matlab, it means that EPS will fall by 100%. And when it falls by 100%, student, that means your combined leverage is 4. Now, with the help of degree of combined leverage, student, I can calculate contribution upon EBT. Yes, no? And this is 4. Do we have contribution? 10 lakh? Yes. Do we have EBT? No. This is 4. That means, can I calculate your EBT? Yes. That EBT will be 2,50,000. Very, very important application of combined leverage. This was an indirect way of giving you combined leverage. That due to change in sales by 25%, EPS will change by 100%. And that gives you combined leverage 4. Now, students, concentrate well. EBT is 250. The balancing figure is interest 1,50,000. That's it. Good to go ahead. Check out tax rate, student. Tax rate is how much? 50%. I can say this is 1,25,000. Am I right? PAT is 125 now. Preference is 0. This is 125. And what are the number of shares given, students? Number of shares are how much? Number of share is 1 lakh. This is divided by 1 lakh. So 125 divided 1 lakh, your EPS is 1.25. Student, very class interpretation of combined leverage. Now again check the question. What they've asked you is, what is EPS done and amount of debt capital? Students, now if I answer their queries, student, the first query is, what will be the EPS? Yes, I can say EPS is 1.25. And number 2, amount of debt. So student, interest is like 1,50,000. Interest rate is 16%. So can I calculate amount of debt? 150 divided by 16% is 9,37,500. Amount of debt we have calculated with the help of comparison of interest and interest rate. The best part about this example is it's a computation of combined leverage. Fair enough. So again I revise. With the help of DUL we calculated EBIT. With the help of EBIT we calculated fixed cost. Applying a table and thereafter applying a concept of combined leverage, we calculated EBT and interest, and thereafter after calculating EPS we calculated debt capital. Fair enough.